The Diverse Income Trust has a unique multi-cap approach, aiming to generate both income and capital growth. It is managed by Gervais Williams and Martin Turner at Premier Miton Group. They aim to provide an attractive and growing level of dividends, along with long-term capital growth from a diversified portfolio of primarily UK-listed companies across the market cap spectrum. The fund has a bias to high-quality small and mid-cap stocks. The trust managers are very upbeat about the trust's prospects and are especially bullish about its small-cap stocks, given their inexpensive valuations. Williams recently said that he was more optimistic about UK small-cap stocks than he has been in the last 30 years, and believes that we are entering a super cycle of small-cap outperformance. With around 120 names in the portfolio, the trust is more diversified than its peers in the AIC UK equity income sector. This means that the trust is not as reliant on a limited number of companies to generate its income. The multi-cap approach also provides a broader investable universe and reduces the trust's income risk. It has exposure to all 11 market sectors, and the trust's portfolio is broadly split, with large caps representing 20% of the portfolio, mid-cap companies making up 20%, while small-cap businesses representing 55%, with the remaining 5% primarily attributable to cash. The trust offers a low-risk way to participate in the UK equity market. Our cumulative 10-year upside and downside analysis shows that while the trust may not fully participate when share prices rally, there should be an element of downside protection during periods of stock market weakness. While larger cap companies may have been favored in recent years, over the long term, small-cap businesses have generated superior total returns for shareholders. Williams and Turner refer to this as the small-cap effect, where the returns of quoted companies are inversely related to their market caps. With its multi-cap approach, which aims to generate attractive returns whatever the market environment, the trust is well positioned to benefit from its small-cap exposure over the long term. According to the managers, historically, during periods when the UK outperformed international markets, it was led by the performance of small-cap stocks. The trust has a clearly defined investment process. Williams and Turner select stocks following thorough fundamental research, seeking companies that can generate sustainable cash flows to support growing dividend payments. Businesses that generate the largest long-term dividend growth are often those that also deliver the best capital growth, and the bias towards smaller firms, which are often under-researched, increases the opportunity to find mispriced securities. The managers use a traffic light system, red, amber, and green, to assess companies based on 5 key questions. Are there prospects for rising turnover? Can corporate margins be sustained? Is the management team good enough? How much financial headroom is there in the balance sheet? And finally, does the share price reflect low expectations? Due to the stock-specific investment approach, the trust does not have a formal benchmark. Performance is measured against the Deutsche Numis All-Share Index. The trust is not geared. It has a progressive revenue and dividend growth record. It has continued to grow its income and dividends, despite its capital growth being hampered by poor investor sentiment towards UK small-cap stocks. Holdings are sold if their valuations are no longer attractive, and the proceeds are reinvested into less expensive companies. This process provides a yield pickup which supports the trust's strong and rising dividend stream. If you would like to learn more about the Diverse Income Trust, please visit Edison Group website.